Hello, everyone. Welcome to the annual market forecast. I'm Justin Soucy with G&S Capital, and I have Tara Henderson and Lou Harris joining me today. So today is Thursday, February 18th, and we just wanted to take you through some things we're looking at and things we're watching in the coming year. So we're going to start with domestic equity, look at some size and style shifts, sector rotation, kind of address whether there's a tech bubble or not. Move into international markets. Tara is going to start with fixed income, and then we're going to hit a couple of hot topics that have been in the news a lot lately and just give you our perspective on those. Before we do that, just a quick update on us and how we're doing and just sort of the new normal of the last year or so. Working from home, homeschooling, there's certainly plenty of things here that we can kind of lament over or say, we wish things would have been differently last year or disappointments, but we wanted to kind of focus on some positives that came out of it. So if I maybe start with Lou here, maybe what are some positive things or things you enjoyed about the new normal?
Yeah, no, it was kind of an exciting year in all ways, shapes and forms. And, we welcomed our third son last year right around middle of April, which was kind of fun. So we were right in the thick of pandemic, and then we had to deal with this school from home and get the kids back into a routine that gave them some structure. So I think what I was most proud of the last year is that we survived and no one got COVID and the kids are all back in school. So just a lot to be thankful for.
Good. How about you, Tara?
Yeah, so 2020 was an exciting year for my husband and I. We actually welcomed our first child. So we had a little girl in July of last year. So it was certainly an interesting time to be pregnant during a pandemic and welcome a little baby infant with everything going on. But I will say it was probably a good time to be isolated at home when you have a newborn where you're really not going out anyway. So 2020 will always go down in the books as being kind of bittersweet for us.
Cool. Yeah, and just a little update on me. We did not have another kid, but we did add another puppy or another dog to our lives. So that's been fun and exciting. I'm not sure we needed another one, but I lost that battle with the wife. So I think too, just on a G&S Capital front, just really proud of our team and kind of how we responded over the last year or so in this unprecedented environment. We've heard kind of lots of horror stories from people trying to get a hold of their financial institutions or open accounts or calling 800 numbers and nobody's responding. And so just really proud of our team and that every phone call got answered, every client request got executed, just the way that we were able to kind of come together and make sure that we were still supporting our clients. So super proud of that, and hopefully we're moving back to more normal. 2021's been interesting already, but hopefully we'll get back to a little more of the way things were. Well, to kick things off, I'll flip it over to Lou. He's going to talk about domestic equities, size, style, and sector rotation.
Thanks, Justin. Yeah, just pointing out some of the things we saw towards the end of 2020 and into 2021. Some of the biggest shifts were from large caps to small caps towards Q3 and Q4 of last year. And just to touch on the differences between the two, typically large caps or giant caps are your companies that have a market cap of $10 billion or more. These are your Facebook, Apple, Amazon, Google companies. They've led a decade of dominance, which is great, and we do need to see some rotation, which we are, into small caps, which typically they do better when the U.S. market is in recovery mode, which we are. The U.S. is a little bit more U.S.-centric in investing right now, and small caps have been a little bit overshadowed by large caps for a while. But just the year-to-date numbers in 2021, small caps are seeing a lot of dollar rotation, which is great. And so we've been shifting towards small caps in some of our models through exchange-traded funds and other individual stocks as well. So that's just one of the shifts we've been seeing. The other is a shift from growth companies to value. Growth companies are similar to what I talked about before with the large caps. They are reinvesting their revenue back into the company, typically not paying a lot of dividends. They're considered momentum companies. But the shift started to happen in Q3, Q4 of last year, and we've seen that those dollars flow into value companies, the Procter & Gamble's of the world or Texas Instruments or Caterpillar. And this chart is going to show us that simply growth is overvalued. So anytime that we're at this low point that you can hear where Justin's circling, that tells us as advisors and that the growth is overvalued and it's due for a little bit of rotation to value. So all these go in hand just to see that it's going to take some time, but we're starting to see the shift. We already have a lot of investments in the value sector already, and it's time to take a look outside of growth, which has been leading for the past 10 years. So it's good rotation. We really haven't seen this type of overvalued or high price to earnings ratio since the 2000s .com bubble. We're going to talk about the tech bubble later on in the presentation if we think there is one or the signs of what we're seeing. But overall, the shift from large cap to small cap and then from growth to value is where we're seeing the most rotation right now.
Yeah, and just to harp on maybe a few sectors and themes where we kind of think are more favorable versus less favorable. You kind of see our list here on the left-hand side. We still like technology and innovation. I mean, obviously that's something that can continue to drive the markets. Healthcare and biotech innovation is another area that we really like. But we've kind of paired that with some, I guess, more traditional sectors and themes like the industrials, metal and mining, oil and gas. Again, if there's a recovery and things become a little inflationary, some of these can provide some hedges there. Also, if there's an infrastructure package, we want exposure to industrials and some of those larger companies. Consumer discretionary is an area too where we just have to be really picky. There's some companies that have just done really well through this environment and have even more customers than they had before. Others that have just kind of been crushed. So we have to be picky here, but we like this area. And then lastly, kind of the IPO market. It's still been a market where risk taking is happening pretty regularly. So new companies coming to market, whether it's through an IPO or through a special purpose acquisition company. Either way, we want exposure to those companies. Some less favorable, again, we think financials maybe is moving over into this other column, maybe a little too early to tell, but real estate, utilities, consumer staples, they might suffer a little bit with some rise in interest rates and just lack of risk taking. And then work from home, a lot of the stocks that if people do go back to work, not that those are going to do horribly, but maybe they slow down a little bit. So again, those where we have either overweights or underweights based on exchange traded funds or individual stocks. I think this just kind of shows real estate. This is going to be maybe a longer term recovery. The green line here shows that we've kind of got a historic level of people reducing office space. This last peak was in 2009 after the financial collapse of 08. So, will this continue or recover quickly? It's probably going to be a longer road to people adding to office space. The next one to maybe take a look at, this is more of the consumer staples space. So this looks at 5-year average returns for more value companies. And this is a little difficult. I mean, normally these value companies do pretty well when markets get weak and you have recessions and things like that. This one was so unique because of the COVID environment of it that value companies have still not really recovered, and they've never lost money over a 5-year period, this consumer staples group. So we're thinking we'll have a little bit of mean reversion here at some point, and we still like these companies, just having to be a little more patient here. Lastly, kind of the tech bubble conversation. Again, we do know that these stocks, Apple, Microsoft, Amazon, Google, Alphabet, same thing there, but Facebook, when we look at the size of them in the S&P 500, they're now representing a large chunk of the overall market. There's a handful of other companies in here representing this next chunk, but when we look at 314 of the companies within the S&P 500 last year, basically with negative returns. That might have improved a little bit more towards the end of the year, but just kind of goes to show these big tech companies are driving most of the market. And And that's okay, but we'd like to see it spread out a little bit more. This shows it a little bit more from a percentage standpoint of if you look at the return of the market throughout, this was December 24th of last year, you can see that basically 100% of the return came from tech, consumer discretionary, which is basically Amazon, and then communication services, which is basically Facebook. So any sort of diversification into these other asset classes, which are important to us to have allocations to, at least to some extent, just for diversification, those areas really struggled with either flat to negative returns, everything else being driven by these big companies down here. So again, a little bubblish, maybe a little bit of air needs to come out of some of these bigger names, or maybe they just go sideways for a while. And we are starting to see rotation into these other areas of the market. Just one last piece that just addresses speculation in the market, risk-taking appetite. When people received their stimulus checks and there was no Las Vegas to go to and no sports to gamble on, a lot of small traders, retail investors opened brokerage accounts, and you can see this level of historic risk-taking. This has probably created bubbles in certain names and certain corners of the market, so we think some of this will unwind eventually, but just kind of shows the risk appetite from some of these retail investors and where they're investing, not necessarily caring about earnings or growth rates or fundamentals or any sort of value within the companies themselves, but a little bit just on the speculative side. So again, is there a tech bubble? Maybe not yet. It's a little extended, but something we're going to be keeping an eye on and make sure that we're not overexposed in the tech area. I'll hand it back over to Lou to cover the international markets, emerging the U.S. dollar.
Yeah, thanks, Justin. Speaking of just rotation, we're finally seeing some international markets pick up the pace here, since they've been sort of stuck in a decade-long sideways movement, which we've touched on in previous presentations. But I wanted to talk specifically about emerging markets. We've seen a lot of information and news headlines about emerging markets, but just wanted to talk about what they are. It's really countries that are focused on modernization. They're focused on providing more jobs for their people and trying to plug into the global market. So what happens with that is you have more folks that are employed, have more purchasing power, and that can get their first iPhone in 2021. And so what happens from that moving forward is that there's a rise of consumer consumption. So we've been tracking a lot of smaller and larger countries too, such as India and China, just as the rise of consumption continues to grow, seeing a lot of that emerge through emerging market ETFs that diversify across the world. So we're definitely watching that in some of our tactical models, where we can use exchange traded funds to invest in different part of the world that are starting to emerge. And also just wanted to mention that we have seen emerging markets do this before. They are at all-time highs, and typically within the past 15 years, the last time this happens around 2007 and 8. So we're cautiously optimistic. We're hoping that since there's been so much growth in the U.S. that maybe this bubble is about to burst, those dollars need to go somewhere else. And speaking of dollars, with the weakness of the U.S. dollar recently in the past year, that's a good thing for emerging markets. It makes our goods cheaper. So we are definitely keeping a close eye on emerging markets, as we've got different places to invest. There's a lot of companies like Amazon or Facebook that are developing in other countries, and they are under different names but do a very similar thing. So what we're looking at here is the International Monetary Fund's 2021 economic growth outlook. The top three percentages are in China, India, and the ASEAN 5. Basically, what we're looking at is these two huge sleeping behemoths, China and India, and then the ASEAN 5, which is made up of Indonesia, Malaysia, Philippines, Singapore, and Thailand. So those countries combined are very powerful, and we're seeing a lot of growth there. So we're keeping an eye on that to potentially start to add more investments throughout and rotate the dollars out of the U.S. What we're seeing here is just the chart of the U.S. dollar over the past year. Everyone knows with the fiscal policy that's been taking place over the past year, that flooded the economy with more dollars, weakening the U.S. dollar. And again, that's good for other countries who are buying our goods, and it should continue to fuel that growth.
Yeah, and as Lou mentioned, this weakness as the U.S. dollar comes down is really wind at the back of the international markets. So, that currency effect really helps those international markets. So maybe this will be the push that those international markets have needed to get out of that 10, 15-year sideways range.
Absolutely.
Next, we'll go over to Tara on the fixed income outlook, interest rates, and inflation.
Thanks, Justin. Fixed income is an important component for a lot of our portfolios, and it's certainly been a challenging environment with recently with where we've seen interest rates. So when we're looking at interest rates, this is a chart of 10-year Treasury yields over the last 15 years. In 2007, rates were at about 5.3%, falling lower, hitting an all-time low of 0.4 in March of 2020. Today, we're closer to about 1.3%. We do anticipate rates climbing this year. Maybe we get to about 1.5 or 2% before the Fed comes in and starts controlling those rates. But a big part of the rates discussion that the Fed is looking at is certainly going to be what's going on with inflation. So inflation has certainly been a topic in the headlines recently. There's arguments for low inflation, including technology advances that are creating efficiencies, keeping prices lower. The velocity of money, or the speed at which money supply is moving into the economy, is still pretty low. And we'll touch on that here in a couple minutes, a little bit further. And then just where is inflation right now? Currently, we're at about 1.5%. On the flip side, and the reason why we're a little concerned about inflation, the big elephant in the room is obviously all of the unprecedented government stimulus and Fed support that we've seen expanding the money supply. Production of goods and services is still below pre-COVID levels, so we haven't really seen that supply increase. And then as far as the recovery goes, this pandemic could certainly act and look a lot different than our typical financial crisis recessions that we've seen in the past. So with all of that being said, we think that the scale is kind of tilting more towards that higher inflation side. So this next slide here is going to show, again, kind of going back to that velocity of money. So this chart shows that bank deposits kind of over the last 10 years or so, kind of sticking on a linear line up until 2020 when COVID hits, and we can see a big spike in bank deposits. And those funds really haven't come back into the economy. So again, the velocity of money is pretty low right now. But when you have a quick recovery on the horizon, additional stimulus that's coming down the pipeline, we really do see demand and spending potentially picking up pretty quickly. And the supply really isn't going to be able to keep pace. And that's certainly a recipe for inflation. So we are hedged for inflation in our portfolios. Assets that typically do well in inflationary environments would include gold, commodities, metals, oils, all areas that we have recently been adding to our portfolios. With rising rates and inflation on the horizon, what does this really mean for where we are with fixed income, and how are we looking at this in the future? So currently we're kind of underweight bonds, historically speaking. Traditional asset classes that are typically a little bit more interest rate sensitive, like U.S. Treasuries, we have no exposure there. Investment grade corporates, we have a little bit, but again, underweight. Certain areas that we are looking at would be kind of more of those non-traditional areas where interest rates are a little bit higher, might have a little less interest rate sensitivity. So we've recently been adding to emerging market bonds. We have exposure to CMBS as well as municipals. So we'll certainly be watching interest rates very closely, keeping an eye on the bond market, and hopefully looking for opportunities in the changing environment. So Justin, I'll pass it back to you.
Thank you, Tara. Yeah, and I think just big picture asset allocation wise, as we kind of move into the last section here, equities, like Tara mentioned, kind of stay overweight equities. We're probably going to have some corrections along the way, like normal. That's just kind of part of the process, but we do think most of those will be bought up just because these other areas to put funds, these are kind of your other traditional alternatives, and if you're hanging out at 2% over here, with inflation might be 2-3% or more, we think these rates would have to get quite a bit higher for money to leave the stock market long term. So again, anything can happen. Hopefully not. I think last year was one of those years of anything can happen. So let's not repeat that. But just big picture asset allocation. That's how we're going to stay positioned. Into the hot topics. Again, these are just meant to just touch on these a little bit. But Bitcoin's been in the news a lot, short squeeze with GameStop and some other stocks, and then just an opinion on Biden's tax plan.
Yeah, thanks, Justin. So just to touch on Bitcoin, it has finally crossed that psychologically significant dollar amount of $50,000. Still above it today, which is it's good to see. It's still pretty young in the technology adaptation. There's 5 phases of technology adaptation. It's really just in the second phase, so it's starting to see some institutional interest, which is good. Of course, the purchase of $1.5 billion worth of it by Tesla certainly helped pump it up within the past few weeks. So it's starting to gain some ground, become a little bit more commonplace to talk about how we're going to use this to pay for things in the future. So it's still early. It's still just a little bit uncomfortable, but we are investing in funds in some of our models that do have positions in Bitcoin, whether it's through another fund that tracks the price of it. There's several different ways to get exposure to Bitcoin, so we're certainly keeping an eye on it, and we'll continue to allocate where appropriate.
Yeah, and I think for instance, the innovation fund that has a small percentage to it, it's not something you want to make a huge part of your portfolio. At these stages, it's extremely volatile. But yeah, having a little bit of exposure there, as Lou mentioned, these institutions adapting it has certainly been nice. Yeah, the next short squeeze. Just these names you've seen in the news when it comes to GameStop and things like that. I think that kind of basically complements that earlier chart of retail traders getting into the market and really pushing things higher, grouping together to buy a stock. Again, a short squeeze is really when a large number of investors have borrowed the stock thinking that the price is going to go down and they're going to buy it later at a lower price. Well, when that price doesn't go down and all these other investors push the price up extremely high, that's a very painful position for these hedge funds and other investors to be in. So they have to rush out to buy the stock and replace it, pushing the price even higher. So again, it's a little bit of a sign of excess. I think it's also a little bit of sign of how reckless some of these retail traders are. And again, they're not really investing. I mean, some of these companies, there's no real long-term reason to justify the prices they got pushed up to. So again, it's been in the news. If you ever have questions about it or see terminology you don't understand, or just want to chat about it, give us a call and let us know.
Yeah, and I think a big question that's on a lot of people's minds right now is, what's going to happen with taxes? So we are kind of looking at a few areas that we think will impact our clients and potentially the market. So what we see as kind of most likely happening, the highest income tax bracket, it's been proposed, reverts back to 39.6%, kind of where it was before 2017 tax cuts. So it would be an increase of from 37% to 39.6 on income over 400,000. We think that that's likely to happen. And then corporate tax rates increasing from 21 to 28%. So kind of keeping those in the most likely category. Looking at a couple of other areas that are maybe a little bit more uncertain or less likely. Right now for long-term capital gains, the proposed change is if you make $1 million or more, your gains will be taxed. Currently, they're taxed at 20%. The proposal is to revert those to that highest income tax bracket level of 39.6, essentially doubling the tax. We do think that that's a pretty extreme move, and we could see maybe other options thrown out there before that's actually passed. The other hot topic with the Biden tax increases would be the elimination of step-up and basis. Again, this is just a preferential tax treatment that beneficiaries receive when inheriting an investment. Essentially, their cost basis steps up to the market value at the time of death. So that would have a pretty major impact for a lot of people, but really it would probably be an accounting nightmare. I mean, there's so many people that have not tracked their cost basis. So, you know, we kind of think that that might be a little bit more unlikely, at least right now. What could potentially happen though is the estate tax exemption amount. It's currently $11.7 million. We do think that there's a good likelihood that might revert back to, you know, maybe $4 or $5 million. So, and again, another big question that we're getting is, are these tax changes going to be retroactive to 2021, or are they going to take place in 2022? And we think that with where the economy is right now and unemployment numbers, we see that as more of a 2022 tax change. But right now, we're not anticipating tax changes to have a huge impact on the markets. So this next slide is just an interesting chart showing market returns during different administrations. It helps demonstrate that the market really doesn't care whether a Republican or a Democrat is in office, and markets really can do well with either political party.
Good, thank you, Tara. I think lastly, some of you probably noticed this in our Christmas card that came out, just some of these one-line items here, just words to inspire you, I guess, and we just thought we would pick our favorite one and just kind of share that with you. And I'll start with Tara first this time.
Yeah, I like the don't worry, less wrinkles are more becoming. It just kind of reminds me of my mom. When I was little, I would actually watch her put Scotch tape on her forehead every night before she would go to bed. And that was basically her way of saying, this is what's going to prevent me from having a lot of wrinkles when I get older. And I will say she probably looks 20 years younger than her actual age. So I might start doing it soon.
Yeah, me too. How about you, Lou?
Yeah, thanks. The one that spoke the most to me was just to appreciate the little things in life and enjoy them, without a lot of vacations to look forward to and things really outside of our home, whether it's going out to eat or meeting up with friends. I think it's just important to appreciate your family and your friends or your pets, whatever's close to your heart, and really, appreciate the quiet times you have with your family. I think it's just been a lot more important now than ever. So that's been pretty fun over the past year to really see the family grow together.
Cool. Yeah, I'd say for me too, I kind of like the top one. Life is not a race, but indeed a journey. And I think that's kind of, been evident with a lot of clients that we see go through different stages of life and, different highs and lows with their careers and family and health and jobs. And so it's, we get kind of a constant reminder of where people are in those stages throughout our client base. So it's, the ones that seem to be the happiest are the ones that are enjoying the journey. So I try to take that advice from them. Last but not least, the rest of our team here, just again, if there's any questions, anything that you need help with, obviously we're here to help you. And just really proud of the team and how we've kind of come together over the last year or so to get through all of this together. And looking forward to seeing folks in person. And then also follow us online. We do post to our LinkedIn page. We're not involved in any other real social media by choice, but LinkedIn will put out perspective pieces there, maybe some updates on team members and stuff throughout the year. So please follow us there. Again, as always, if anything's changed with you, if you have any questions, if you want to talk, markets or your financial plan, we're always here to help. So appreciate you and look forward to seeing you in person soon.
Thanks, everybody.
Thanks.